Everything we do on this channel is built around one core idea. Markets don't turn because of headlines. They turn because of labor, income, credit, and liquidity. This strategy is designed to survive three outcomes: a continued melt-up, a surprise breakdown, or a slow grind into recession. We're not predicting crashes. We're tracking probabilities, sequencing, and signal convergence. This video fits directly into that framework. The video we're about to discuss challenges one of the most widely accepted narratives right now: that the economy is strong, that GDP growth proves everything is fine, and that recession risks are overblown. The argument you're about to hear is very different, that the economy is actually on thin ice, and that the strength we're seeing may be far more fragile than it looks. The analysis in this video comes from David Rosenberg, president of Rosenberg Research. Rosenberg has spent decades focusing on income, labor, and cycle dynamics, not just market narratives. I strongly recommend watching his full video for the complete detail. My goal here isn't to replace his work. It's to translate his analysis into how it fits within our strategy and probability framework. Before we go further, a quick disclaimer. Nothing on this channel is financial advice. I'm not a financial advisor, and this content is for educational and informational purposes only. I'm sharing how I personally think about markets, risk, and capital from a macro and risk management perspective. Any decisions you make are your responsibility. All investing involves risk. Rosenberg's first point is about GDP. The headline number looks strong, but he argues it's misleading. When you strip out government spending, falling imports, and savings drawdowns, real growth drops dramatically. The most important detail is this: roughly 60% of reported GDP growth came from a decline in the personal savings rate. That's not organic growth. That's borrowing from the future. Here's where this really matters. Consumer spending is holding up, but real disposable income has been flat for months. That means people aren't earning more. They're spending savings instead. This creates a wealth effect economy, not an income-driven one. Historically, that's a late cycle condition, and a fragile one. Rosenberg's strongest signal isn't GDP, it's labor. Adjusted payroll growth is near stall speed. Hiring is slowing before layoffs rise. That sequence matters. Historically, when payroll growth falls toward these levels, recessions tend to follow, not immediately, but reliably. This doesn't mean a crash tomorrow. It means the foundation is weakening. Rosenberg makes an important point that aligns with our framework. Right now, the stock market is driving the economy, not the other way around. Rising asset prices support confidence. Confidence supports spending. Spending props up GDP. This explains why recession signals can coexist with market melt-ups. It's not a contradiction, it's a phase. This fits cleanly into our phase framework. Early on, liquidity and wealth effects overpower fundamentals. Later, labor and income start to matter again. Once markets wobble, the feedback loop reverses. That's when spending weakens, GDP rolls over, and narratives change fast. Rosenberg is early, not wrong. Rosenberg is very clear on one thing. He favors bonds, U.S. Treasuries, and UK gilts. That aligns with our duration exposure. Growth breaks before inflation fully resets, and the Fed reacts after labor deterioration becomes undeniable. This supports holding duration through volatility, not trading it emotionally. On equities, Rosenberg warns against passive index exposure. He expects this to be a picker's market. That fits our approach. Selective participation, defined exits, no buy-and-forget mentality. On hard assets, there's meaningful overlap: gold, energy infrastructure, defense, utilities. These are assets that tend to matter when growth slows and confidence erodes. So what does this change? It raises medium-term recession risk, especially over the next 12 months. It does not invalidate near-term melt-up participation. It reinforces the need for defined exits, optionality, and disciplined risk sizing. This is a fragility signal, not a timing signal. It's important to say this out loud. This thesis weakens if we see sustained real income growth, hiring stabilizing without layoffs, savings rebuilding instead of falling, household credit expanding responsibly. Until then, caution is justified. Here's the bottom line. Strong GDP numbers don't always mean a strong economy. When growth is driven by savings depletion and asset prices, the system is more fragile than it appears. This is exactly the kind of environment where being early feels wrong, until suddenly it doesn't. This strategy isn't about calling the moment. It's about being prepared for the phase. watching labor, watching income, watching behavior, and staying flexible while others anchor to headlines. We don't need to be early, we just can't afford to be late.